Hi guys, welcome. Today we are going to talk about the overview of financial management. Let's begin with finance as a whole. What is finance? The best way to define finance is to enumerate its three areas. The three areas of finance include financial management, capital markets, and investments. Capital markets deal with the markets where interest rates and security prices are set. An example of this would be the stock market. Investments. This pertains to the analysis of bond, stock, or any security or fund's value. Our main event would be financial management, also known as corporate finance. The best way to understand financial management is to know the activities under its scope. It includes what assets to acquire. This is the investment question. How to raise capital needed for the purchase of such assets. This is called the finance question. How to run the business, which is the operating question. The investment question deals with non-current assets, basically the left side of the balance sheet. The financing question would deal with the right side of the balance sheet. Sources of funds can come from liability and equity sources, while the operating decision would deal with the current items. In dealing with these three issues, we have to take note the primary goal of the corporation. The primary goal of the corporation is to maximize shareholders' wealth. Shareholder wealth maximization. Shareholders' wealth is a measure that is futuristic and long-term. It is to be noted that maximizing shareholders' wealth does not necessarily equate to maximizing the profits for the current year. Profits are past-oriented and tend to be a short-term measure of performance. To understand why maximizing profit does not necessarily equate to shareholder wealth maximization, let's say for example, a research and development expenditure. A decision to undertake research and development will definitely decrease the profits of the company. However, in the future, it might actually increase shareholders' value. Again, maximizing shareholders' wealth does not necessarily equate to maximizing the profits. At the end of the day, shareholder wealth maximization should be accomplished within the bounds of ethical behavior. But how is wealth determined? Wealth is basically value. So the question would be, how do we determine value? The value of an asset is the present value of the stream of cash flows that the asset provides to its owners over time. To know the value of an item means to know how much one is willing to pay for such an item. The value of an asset again, the value of such an item again, is the present value of the future cash flows it is expected to generate. This would bring us to the concept of intrinsic value. Intrinsic value is a stock's true value based on accurate risk and return data. In the real world, it can be estimated but not measured precisely. So how much are we willing to pay for an asset? Well, we should have complete information about the future cash flows it is expected to generate, the timing of such cash flows, as well as the risks involved in the purchase of such an asset. Unfortunately, such an information is not necessarily available. That is why in the real world, we can only estimate the intrinsic value. Similar to the intrinsic value is the stock price. or the market price. This is the stock value based on perceived but possibly incorrect information as seen by the marginal investor. Again, although ideally we want the two to be the same, they are not necessarily equal. Of course, investors can always go wrong. We want the situation, however, of equilibrium. Equilibrium is the situation in which the actual market price equals the intrinsic value. In this situation, investors are indifferent between buying and selling the security. To demonstrate how equilibrium looks like, let us refer to the following chart. In this chart, there are two values that we track through time. First, the orange line is the stock price. The gray line, the intrinsic value. Take note, we can only see the orange line, the stock price. The intrinsic value is basically invisible from our point of view. Note that the stock price and the intrinsic value is not necessarily the same. There are times when the stock price exceeds the intrinsic value. This happens when the orange line is above the gray line. We call this situation overvaluation. If a security is overvalued, it would be good to sell the security. You're going to get more from the less that you have. Meanwhile, when the orange line is below the gray line, this is a situation where the stock price is less than the intrinsic value. This is undervaluation. If a security is undervalued, it is a good thing to buy it. It means that you're going to pay less for something that is valued more. When the two lines meet, this is actually a situation of equilibrium. At equilibrium, you're not going to gain instantly nor lose instantly upon buying or selling the stock. Why? Whatever you are paying for, the price, or whatever you are receiving, if you are the seller, would be equal to the intrinsic value. Again, from the social point of view, we want equilibrium. We do not want people to profit from incorrect information. Conflicts of agency. What is agency? Agency is a contract where one party, the principal, engages another party, the agent, to act on his or her behalf. This is the contract of agency. Ideally, the agent should do everything in the best interest of the principal, considering he or she is paid to do that. Contract of agency can be found in the relationship between stockholders and managers. Well, stockholders here are the principal, considering stockholders are the owners of the company. They elect the board of directors, which in turn would hire the managers of the company. So the managers are mere agents of the company's stockholders. An agency relationship can also be found between bondholder and stockholder. In this case, the bondholder, who is the principal, would select the company owned by the stockholder to make good use of their funds. We call this the trust fund doctrine. Again, the bondholders here are the principal, while the stockholders this time will be the agents. Again, there are instances wherein the agent does not act in the best interest of the principal, and that would give rise to the conflicts of agency. A conflict of agency can arise between stockholders, the principal, and managers, the agent. Managers want increased job security, increase their own power and status, more opportunities for their lower managers. These things do not necessarily contribute to the best interests of the principal, the stockholders. And therefore, we should do something about it. We would have mechanisms to motivate managers to act in the best interest of the stockholders. Such would include managerial compensation. It would be better if we're going to align the compensation with the performance of the company, such as granting the managers stocks, direct intervention by stockholders. This can happen when the stockholders are institutional, companies owning companies. The threat of firing, the fact that the manager can be fired, will give them incentive to act better. The threat of takeovers. These are mechanisms that we can put in place in order to motivate the managers to act in the best interest of the stockholders. A conflict of agency can also arise between bondholders, the principal, and stockholders. Basically, stockholders want risky projects as well as additional debt. Stockholders want risky projects because when risky projects pay off, the excess profits would go to them. While if the risky projects would fail, both the stockholder and the bondholder would shoulder the losses. Stockholders would also want to borrow more so that they have to invest less amount. This, however, can be disadvantageous to the existing bondholders. To protect the bondholders from such conflict of agency, the following can be done. There can be debt covenants that limit the amount of debt the company can borrow and constrain them from certain actions, especially risky projects. If the company is taking too much risk, bondholders are supposed to charge higher than normal interest rates. These actions can protect the bondholders from any potential abuses by the stockholders. So that would be the introduction to financial management. In summary, financial management is about 3 activities: what assets to acquire, where to invest in, how to fund the projects, where to get the money, and how to run the business. What items do we need in the day-to-day operations? In doing this, take note that the goal is to maximize shareholders' wealth. The best indicator for shareholders' wealth is the intrinsic value of the stock. However, we cannot see it. What we can see is the stock price. That is the best representative of intrinsic value as far as we in the real world are concerned. Take note also of potential conflicts between agents and principal and know how to deal with such conflicts. Like, share, and subscribe.